Over the next 12 months, we'll explore two primary themes: debt and the dollar. We need to appreciate the substructural changes that are occurring in Asia and in Europe to better appreciate the major shifts here in the United States over the next 3 to 5 years. In this first film segment, we'll look at the crisis in Europe from 2009 to 2011, the changes which have occurred there, and the things that remain constant. Then this summer, we'll look at Asia and the massive shifts which are taking place in China as they try to rebalance their own economy. Then as we get towards the end of the year, finally, we'll synthesize the stories both in Europe and in Asia with our political outlook following the election as we look forward to 2013, 14, and beyond. Several generations will look back and reflect on these events as being primarily responsible for the diminishment in their standard of living. More has changed in the last 4 years than at any time since the end of World War II. Our conclusions remain consistent from last year. Politicians, from this point forward, are choosing the economic winners and losers. An adjustment has to be made. The only mystery is where, when, and who will pay the price. In spite of a near fatal cycle of economic events in Europe, we've seen closer fiscal and political union through the coordination events of the last 2 years in Europe, with Berlin rising in prominence and Brussels being largely discredited. And over the last 2 years, we've seen a global affirmation of the euro as a dollar alternative, with major implications for U.S. policy and dollar reserve currency status. The debt crisis among sovereign nations in Europe has lit a fuse which will ultimately be incendiary in the U.S. debt markets and cause the dollar to lose its single reserve currency status in the world monetary system. The legacy problems remain, that of unbearable levels of debt, which still have to be paid back, leaving us to conclude that the solvency issues in Europe are not behind us, but simply that in the near term, the focus will no longer be Europe, but the U.S. instead. Beginning with the theme of debt, we need to realize that the era of credit-financed growth is over. As we look back to the period of 2007 to 2009, we find that Europe was actually Act 2. We had the subprime crisis in the United States, and that impaired certain financial institutions. Those liabilities, the problems, the solvency issues which began domestically in the United States were then transferred to Europe, and we began the process of implosion in the European space. As the crisis spilled over from U.S. institutions to European institutions, what we found is that in the UK and in the EU, there was actually greater leverage in their financial system than there had been in the United States, and the implications of impaired assets was even greater. Quickly, that burden was shifted to sovereign institutions and central banks. That process of transferring private sector obligations to central banks essentially socialized that risk and left the taxpayer to bear the burden of repaying those bad bets. This is where individual country solvency came into question. The problem had been too many bets on too little capital, too much debt, and not enough income to support it. All that had occurred is a migration from one balance sheet to another. The old problems remained. The only thing that was accomplished was buying time. In the end, the only entities large enough to take on the responsibility of these massive liabilities was the Bank of England, the European Central Bank, and the U.S. Fed. While we are not past the point of crisis, we are beyond the point of imminent demise. We've seen central banks provide liquidity that banks have needed to remain solvent. Now, quite interestingly, the interbank lending, which normally occurs on an overnight basis between financial institutions, is not occurring. Any excess reserves that financial institutions have, they are taking and redepositing with the central bank, implying stress and strain still on those bank balance sheets, a lack of trust, and an unwillingness to lend into the larger economy and do what those liquidity provisions were originally intended to do, provide fuel to growth in the economy. Something is still terribly wrong. The era of credit-financed growth is truly over. If you go back to the United States, you can see that in this period from 2008 to 2011, in order to generate $581 billion in growth in the economy, it took $4.7 trillion in debt to get that done. Think of this, borrowing $8 to create $1 in growth, or to look at it differently, You borrowed $1 to create 12 cents of growth. The math is the same. What does this mean for you? This has direct implications to the stock market. As the credit cycle turns, you'll see depressed prices in equities. You could, without Fed intervention this year, see as much as a 25% decline in equities. Over the next 3 to 4 years, you could, again, without Fed intervention, see as much as a 30, 40, or 50% decline in the stock market. If you have concerns about a stock or bond portfolio, contact our office for a second opinion. We'd be happy to let you know how much risk is in your portfolio today. Now we focus on the dollar and its reserve currency status. The euro has remained a contender, and as we'll explore later in the year, the yuan will also become a part of the international monetary architecture. These changes have radical implications. In brief, how did we get here? The crisis began in the US. It went across to Europe via the banks. Those banks had to be accommodated or bailed out by national central banks that ultimately have to be bailed out themselves by the ECB. But there's an undercurrent here because it's not just bad assets on individual balance sheets that ultimately migrated to the central bank, European Central Bank. We also have an incompatibility between northern countries in Europe and southern countries in Europe. The savers, if you will, in the north, the spenders, if you will, in the south. This distinction between northern savers and southern spenders is not quite that simple. If you look at the legacy responsibilities, the same type of thing that we have in the United States through Social Security, Medicare, Medicaid, what you have is too many government dependents, too many promises to pay, and not enough revenue coming in to support it. That is a demographic problem in the southern states that is more acute there than in northern Europe. So as you encapsulate the problems within Europe, make the distinction between financial issues relating to the banks and financial institutions rolled up into the central bank, but also the issues which are more of an economic nature, a demographic nature, a social nature. These are enduring problems and speak to the main challenge that Europe has. How do you grow yourself out of this? The crisis point peaked in the winter of 2011 with governments unable to affordably fund their debts. This actually was something very similar to what we saw in the financial crisis in the US, where companies were unable to roll over their paper, and that was the crisis in Europe. Who would refund the debts coming due in the Eurozone coming into the fourth quarter of 2011? Essentially, time was added to the game clock. 2015 is the new date with Destiny. We would view this as a temporary suspension. Pressures may reemerge. Primary concerns remain: too much debt to still be paid off, and economies which now, under the stress and strain of new austerity measures, have to figure out a new growth model. As we previously discussed, the old debt-driven growth model is broken, and they can't rely on that any longer. Nevertheless, the euro as a currency remains in the game. What we witnessed over the last 2 years is extreme support from Asia, the Middle East, throughout the world for a dollar reserve currency alternative, and that's what we have with the euro. Whatever has to be done, the differences between North and South, fiscal union, disunion, whatever the solutions are of a political and fiscal nature, it's secondary to the ethos held globally that we need a dollar alternative. That has implications for us. The US dollar is the primary reference currency in world trade, gives us an extraordinary privilege here in the United States, and acts as a subsidy to our lifestyles. The gradual erosion of the US dollar's monolithic stature in the world monetary system is something that we will pay for here domestically. But it's not a question of just simply losing. It's a question of slow substitution. Thus, we focus on both the euro and the yuan in coming months. We're already witnessing the world move away from the dollar, not only in its treasury purchases, but also in transaction settlement, where the euro, the yuan, a variety of other currencies are being used to settle invoices rather than as they have traditionally been done in US dollar terms, which makes us the middleman in every transaction. The US dollar is losing its middleman currency status via bilateral trade agreements between various countries. This ultimately is detrimental to us. What does this mean for you? Consider your bank savings. They're denominated in US dollars. A 20 to 30% sharp drop in the dollar implies a cost of living adjustment for you which may not be affordable. Those living on a fixed income will have it the worst. But look at your family budget. If the goods and services that you needed cost 40 to 50% more, how do you make ends meet? How do you pay your bills? Can you take care of your family? As we consider the issue of debt, let's make sure we look at it on a global enough scale. The total stock of debt we have globally is roughly $150 trillion. That's close to 2.5 times global GDP of $63 trillion. Now, our concern is two things with debt. One, can you pay it back? Or at a bare minimum, can you continue to make payments on it without bankrupting yourself, either as a company or as a country? We're now at a critical juncture. We're seeing global debt grow at 11.2% per year. $150 trillion growing at 11.2% per year. That number doubles in a mere 6.5 years. 6.5 years from now, we have the burden to pay back or make payments on $300 trillion. This is not derivatives, this is not double counting, this is nothing fancy. This is the piper that will have to be paid. While we certainly pay attention to the numbers on a global basis, we're very concerned about debt levels here in the United States. This is where we live. It matters to us deeply. $15 trillion in current debt. At the current rate of 2.18%, the lowest we've seen in many, many decades, equals about $300 billion in current interest-only payments on the national debt. An increase in interest rates even marginally to 3% moves that to $450 billion. 4%, $600 billion. Now, when you set that against our current revenues of $2.5 trillion, that $3, $4, $5, $600 billion really begins to matter. David Walker of the Government Accountability Office many years ago suggested that we can solve this problem. We just have to grow at a double-digit rate for the next 75 years without skipping a beat. Now, the probabilities of that happening are slim to none, so we have to consider other alternatives. Will we meet this great adjustment of too much debt and not enough income to pay it via inflation? Simply pay back the debt with cheaper dollars. Deflation, default, literally just tell our creditors to go away. We'll make partial payments, but they should never expect the full return of principal. Or, lastly, does the government turn to its people and begin to steal directly from them? This is at least the fourth instance in recent U.S. history where we've seen an explosion in the size of government. Different this time, perhaps, is in the backdrop. The fuse has already been lit by the crisis in Europe, and the debt bomb here in the United States is incendiary. The combination of growing government and greater strains on the national fiscal front, we think will be catastrophic. Therefore, for us, 2012 represents a transition year where our fiscal train wreck looks more and more like that of Greece, Italy, Spain, Portugal, the pigs in Europe. That's what we have to look forward to circa 2012 to 2014. That's, of course, looking at it from a financial perspective. When you look at it from a social and political perspective, what you see is a massive secession of power to the government. And we see that in Europe. We see Berlin becoming more prominent, with Brussels fading. We see a consolidation of power around the ECB, and we know that the Germans are just behind the ECB in the backdrop. We have the same thing in the United States, growth in government in response to crisis. It's happening all around the world. The challenge for any business owner or individual trying to make decisions in this kind of environment is that with regulatory uncertainty, with tax uncertainty, you're not likely to expand your business. You're not likely to invest as you might have otherwise. You're not likely to do anything but stay in a very cautious posture. Now, this, at least in the United States, is very reflective of the period between 1933 and 1940. We had 40 monumental pieces of legislation put in place in that period of time, and what you saw is private direct investment evaporated and didn't come back into the marketplace until about 1947, after World War II. And after the command economy of World War II. Private capital was scared by the growth in government, scared by the implications to private property. As government grows and as the requirements to feed this Leviathan expand along with it, the implications are this. The bond market will find a crowding out. Private sector borrowing will be harder and harder as government does everything it can to make sure that it has what it needs to stay alive and thrive. What does this mean for you? If the government cannot fund itself externally via China, Japan, the Middle East, they will come to you. And you say, well, what if I don't want to invest in treasuries? Conscription of capital. The raising of capital controls so that your money cannot leave the United States. Capital controls are the norm in monetary history because, lo and behold, governments frequently are desperate because they do this over and over again. Spend too much, overcommit, don't have enough income to make payments on those commitments. And at the end of the day, it's you, the taxpayer, that has to pay the price. Your assets will be conscripted, one way or the other. Repression of interest rates is just one such way of doing that. Lying about inflation is yet another, as they pick your pocket surreptitiously. The themes of the debt and dollar coalesce when we look at the Fed and Treasury's recent activity. QE1, QE2, these were defensive measures to protect the private sector, to make sure that solvency issues didn't become, on a grand scale, something that were out of control. Operation Twist is different, although it's not the first time this has been tried. In the early 60s, the Kennedy administration did the same thing. Operation Twist then failed and was utterly discredited, and yet we try it again. The great crisis ahead in the U.S. Treasury market is because the Treasury is shrinking our maturities. Our average maturities are now less than 60 months. Corporations are doing the right thing, extending maturities on the debt that they have. Government is not doing the right thing. They're shrinking the maturities on the debt that they have. Now, ironically, Spain, in so much financial duress, is running a deficit the equivalent of 5.8% of their GDP. We're in a worse situation than Spain, and yet we're not in the spotlight, fortunately, at this point. That's the transition for 2012, where the U.S. government comes into the spotlight for the first time. Operation Twist gives us a unique insight into how government is thinking. What will they do to be able to perpetuate the same kind of advantage that Japan has had for years? Very low interest payments on the national debt. Manipulation is paramount. They're doing that. Suppression of interest rates, repression within the financial markets comes at a high cost. It basically is a redistribution of income from savers to government. By holding rates low, savers forego the income, and that income instead ends up on the balance sheet of government. The basics are the same the world over. Too many bills, not enough income. The recent Obama budget has a $1.33 trillion deficit. That's $3.8 trillion in spending on a $2.5 trillion tax take. Again, the deficit's 1.33. We're simply spending too much money. We don't have it, and yet we continue to spend it anyways. We are growing our debt, not an 11.2% rate, but at about an 8% rate. And so it's better than the global average, but still we're compounding our debt negatively at a very rapid rate. Looking at that another way, we're spending 53% more than we're bringing in. We're spending 53% more than we're bringing in. This is insane. You can't do that. You can't do that as a household. You can't do that as a business. And you certainly can't do that as a government unless you somehow are going to make it up someplace else. Default, yes, perhaps. Inflate away, yes, perhaps. Steal, yes, perhaps. Yes, indeed. As the U.S. government is further pressured to fund their operations, what does this mean to you? Redistribution of income in any form is confiscatory. But when consent is given, it's with a certain quid pro quo. What am I getting in return for this? This is the issue of taxation and representation. But consent is a critical variable. When you look at inflation and the impact that inflation has, when you look at interest rate suppression and the theft that it represents, both of these are examples of taxation, of redistribution of income without consent. This is a private property issue. Financial repression and inflation are nothing more than ways of taxing the middle class and households on a non-disclosed basis. It's nothing less than plunder. The importance of hedging against political risk hasn't been this great since World War I and World War II. We are now in an environment where investors need to consider where they have their assets, where specifically on the globe they have it. It's our advice that you have, wherever you live, assets someplace else, anywhere else other than your home country. We've long recommended for 35 years that clients have up to 25% of their liquid assets in a non-home country. In the last 3 years, we've provided two means to do that. A Swiss program based in Switzerland, a Swiss program based in the United States. And now two more programs, Toronto and Singapore, to accommodate client needs and expectations of when and where and how they want access to their assets abroad. The storage program in Toronto is available for private clients in the middle of the year. Singapore will be available by the end of the year. these two options should be explored with your personal consultant at ICA. It's your first opportunity. The precious metals have been in a bull market for over 10 years, and the question often arises, what represents a compelling value at these prices in this market? I can think of three categories which represent extreme value, each with varying degrees of risk. Let's look at each of them in detail. The first is physical gold, specifically $20 gold pieces, St. Gaudens and Liberties, minted prior to 1933. These represent an incredible value relative to gold. Second is silver, also relative to gold and incredible value at the present time. And third, the precious metals miners, the companies that actually dig in the dirt and mine for gold and silver. These companies carry with them extreme risk. I should say that they are categorically for an experienced investor with a cast iron stomach. To explore which of these options is most appropriate for you, contact your ICA broker and ask questions and learn how to proceed now and with an exit strategy into the future. The Eurozone crisis has been fascinating for us. The implications into the U.S. are even more so as we consider the real ramifications into the U.S. stock market, the U.S. bond market, and most importantly, that which underlies all U.S. assets, the dollar. In this first segment, we've explored a few of the issues relating to the Eurozone. In the next segment, we'll look at Asia and the considerable stress that will put on the U.S. dollar and the U.S. debt markets. The crisis in Europe is anything but over. The crisis in the U.S. is just beginning in earnest. It's important to look at the substructural elements impacting the economy, both in Europe and in Asia and in the United States, to better anticipate what we need to be doing over the next 3 to 5 years. Changes are afoot, financially, economically, socially, politically. Are you prepared? An adjustment has to be made. The only mystery is when, where, and who will pay the price.